I want to call my panelists to the stage. I'm told we have 30 minutes instead of 45. So we have to restructure how. Guys, you have been great so far. This, in fact, will be the best panel you've seen so far. So, you know, so expect some insights. So please come on stage. So as they come on stage, allow me to just set the context. So this is stimulating private investment in affordable housing. And why does this conversation matter? I'll tell you. There is a fundamental tension between borrower affordability and investor return. And this balance determines whether or not we can actually scale up affordable housing. The persistent question is, why does private sector shy from getting into affordable housing? Is it because of the perception of low returns? The affordability return tension sits at the heart of every housing finance system. And this is actually the crux of this panel discussion. I have a great set of panelists. These panelists are leaders that are shaping housing finance discourse in their respective countries. They'll be very pragmatic. They are practitioners. And so we want to stimulate a discussion which essentially you will expect to have some takeaways. So you'll get some policy insights. You get some practicalities, of course, from different countries. And because we have, when you look at our conversation map, we have a mix of excellent speakers. We have policy enablers, like, for example, the National Housing Finance Corporation of South Africa. We have financing catalysts, the mortgage refinance companies here, NMRC, TMRC, and PMRC. We have implementer, a primary lender, with the KCB Bank of Kenya. So and I just want to do the introduction of who these people are so that they'll just go straight into answering some of the questions that I have. Of course, we start with ladies first. Caroline Kihara is the director of mortgage business at KCB Bank. She's the only lady there anyway, so you can see, I don't need to mention where she's sitting at because you can see that. We have George Phiri from the far right, who is the General Manager Lending, National Housing Finance Corporation of South Africa. We have Zafar Alam, the Head of Business and Products, PMRC, or Pakistan Mortgage Refinance Company, on the other extreme left. And right in the middle is the chairman of AUHF, who is also the CEO of Nigeria Mortgage Refinance Company. And next to him is Mr. Oscar Mgaya, the CEO of TMRC. Now, in tackling the matter about stimulating private investment in affordable housing, you note that we have discussed, I think, over the last 2 days, public-private partnerships. And I will want them to share insights from their countries. And I will actually start from my far left, from PMRC. What are the most significant obstacles hindering private investment in affordable housing in Pakistan?
Good evening, everyone, and thank you so much, Joe, and thank you so much, AUHF, for this wonderful event, inviting us to this beautiful city of Nairobi. So I was listening all day to all that was being discussed, and I thought I'm going to spend my 5 minutes in just sharing some key takeaways. Because see, if you look at, before even I get started, I'm going to open a can of worms, right? And the can of worms is, are subsidies good or bad for the housing sector? And I've heard a lot, they're not. But I'm still sitting on the fence, and I would share with you a couple of things which I don't want to advocate subsidies, but that would help in figuring it out why targeted subsidies in certain countries are not that bad. Start with the case of Pakistan, right? We are 250 million people, right? Per capita GDP, just 2,000. That's $150 per month, okay? Mortgage to GDP, a dismal 0.3%. With all those statistics, and with your 3-year sovereign bond giving you 11.5%, and the rental yield of 6%, affordability will definitely be a problem, right? A definite problem, because the guy on the street can only afford 6%. The private sector, on the other hand, can get a 3-year investment at 12%. So what the government did in 2018, with all of the hue and cry, they did launch a subsidy program. The subsidy program was not well structured, and that is where practitioners like us would have come in and helped them out in structuring a targeted subsidy program. The program was such, okay, so they set the end user rate at 6%. The banks were told that they will be getting a base rate plus 3%. At that point in time, the base rate was 12%. So you're looking at a 9% subsidy, right? 6 and on the other end, 15, 9, right? But the problem was the structuring wasn't good. It should have been a fixed rate subsidy. And then the rate started moving up. And last year, Pakistan, with an inflation of 32%, experienced a rate of 22%. So the mortgage rates went from 22 to 25. So now you're looking at the consumer paying 6, while the banks were at 25. Yes, the bad name for it. If we would have gone back in time and told the banks, you know what, fix your spreads, say for example 10%, right? So you have to do the mortgage at 6. 10 is what you're going to get throughout the life. Even if the loans is 20%, 10 is what you're going to get. It would have been a much different case. But again, frowned upon, but if structured and done well, I think they should be okay. The second thing that we're doing, and look beyond the end of the spectrum here, I think we had a fantastic conversation with the Indian colleague when they're if you want to do anything in your countries. Next, let's talk about the PPP structure. Okay, then we went on to the PPP structure, and that is what we're doing right now in our country, right? So the government finally came up with the idea they have oodles of land lying everywhere, okay? So the concept is that the land is being given to developers. The developers have been shortlisted. The developers will come in. They have been told to construct in a over here. It's quite structured, and they've also been asked to mention their returns. So we're talking about a cost plus return model, and that is the end cost of the unit that is being constructed. Obviously, with 40% of the land as being the total cost of the unit, and taking that out creates affordability, right? So say, for example, if with the land, the cost was 40,000, it's now 25,000. So the affordability part comes in from this land which is being given for free. Next, what happens in the value chain, banks, when they see that now the government is involved, they start financing the developers, right? So now the developers also, which were not bankable before because of cost overruns, because of delays, have this thing to piggyback on, and they can get some sort of loans from banks. But the banks see that 3 or 4 years down the road, the project is being completed, the consumers come in. So they start converting the developing loans to mortgages. So this is what is being practiced right now. We still have to see the outcome. The first has been done, didn't go well. But the 100 billion mortgage portfolio of Pakistan doubled in just 1 year because of subsidies. So we do have to realize that at one point in time, they are important, right? And the third, we do have the credit guarantees as well. I was also asked to speak about the microfinance sector. Yes, the microfinance sector is quite vibrant in my country. If you talk about the percentage of the total loans as opposed to the microfinance loans, 25% of the house loans are with the microfinance business. But there's a caveat. These are not all mortgage loans. These are incremental loans. So, so you go into a village, the guy already has a piece of land, he has a hut, but he doesn't have financing to make an additional room, right? So there the microfinance banks are like perfect like lenders because although the cost is high, the quantum of the loan is low.
Thank you, Zafar.
Thank you.
Caroline, what holds private investors back in Kenya?
Thank you very much, and really honored to be here. So before I answer that question, allow me to just go back to where we were before KMRC came into play and where we are at and how we see that affecting the real estate landscape in the country. So about 5 years ago, the average loan size, mortgage size, was in the highs of 9.9 million. And for the few years that KMRC has started operating, that has started going down. What has that done even in terms of financial institutions? Our risk appetite and lending is more to developers that are doing affordable housing because there's mass, there's scale. But there's one thing that KMRC, as you may be aware, KCB is the second largest shareholder into KMRC outside government of Kenya. And one of the things that KMRC does is that it has handled the demand side of the market. The supply side, and which is the developers that are sitting in this room, is yet to be addressed. So therein lies the challenge. Because today the cost of construction for a developer is the same, the cost of materials is the same, the cost of labor is the same. There has been effort to subsidize, give certain subsidies. I will not call them subsidies, I'll call them incentives. I think there's waiver of VAT on inputs for any developer that's putting up 100,000 units and above. There's also a bit of leeway on the corporate tax that a developer that is operating within that space pays. So they don't pay the 30%. It has been reduced. But there's an opportunity to be able to work with the success that the PPP KMRC has brought in. There's an opportunity to do more to be able to address the supply side. And I think these conversations come in very timely when we talk about blended finance. What does a developer want? They want a quick exit. An investor wants to put in their money. They don't want to be tied in for more than 3 years. In fact, if you get one that is patient enough to want their money to stay for 3 years, you're very lucky. Majority will want within 2 years, they want out. So there's an opportunity for us to focus more on innovative financial solutions that will help address that supply side. And out of it will be creation, and I'm happy that today we had people talking about I-rates. We've had some that are successful, more are coming into the market, because these are the instruments and engines that will give an exit strategy for the developer and provide an avenue for more investors to be able to come in. So the conversation is very, very relevant today. As we speak today, and even as I look at the journey that we have worked with KMRC and the impact it has had on the market, the team, we've had to reorganize the way we sit even in the bank because we've moved from handling a few mortgages to quite a number of mortgages. From where our legal department is sitting, we've had to reorganize ourselves. There are still issues to be handled. The titling process in this country is a big nightmare. A lot of developers will tell you they have injected capital, but they can't get their money out. because they have to wait for sectional titles. So again, there's an opportunity in there to ask ourselves what in between, whether it's de-risking that can be done to be able to get the investor, get their money out and be able to roll it over and then, convert that either into mortgages or into some longer plans. So I think one of the biggest challenges is around what is in it, because investors are in it to make money, and many will ask, what is in it. The other thing for private investors, which they're very keen on, is the current approval process. Whether it's your NEMA, whether it's your drawings getting approved, whether it's your National Construction Authority, there's need to just have that sitting in one space, because there's a lot of movement, and unfortunately within government, the more you have too many movements, the more there are opportunities for people to ask for kitu kidogo. That is French. You ask your neighbor, what is kitu kidogo?
Thanks, Caroline.
Yeah. So I think those are the challenges, but they're not things that cannot be resolved. They're things that we can be able to resolve.
Absolutely. Now, George, National Housing Finance Corporation is predominantly funded by government. To what extent have you tapped private sector funding for purposes of increasing your loan book?
Thank you, Johnstone, and thank you for the opportunity. Yes, the National Housing Finance Corporation, as you said, is a state-owned entity that was established in 1996, and it was only ever capitalized once by the state at the tune of about 880 million. Those that understand dollars, it will be like $50 million. And to date, it has grown to up to a net asset value of about 5.5 billion, which is about 297 million US dollars. And all of that has been achieved through partnering with private developers that are operating within the affordable housing space. So the National Housing Finance Corporation has never been capitalized since 1996. So therefore, we are a very good example of how we used or utilized that limited state financing to where we are today. So we are currently operating nationally in South Africa. We have various products that we finance across, mainly private rental. Private rental would be your open market rental. That will also include student accommodation. And we also do social housing in partnership with the state, where we fund developers that would want to operate in the social housing space, and that is subsidized rental. And then obviously when we do have our sales products, where we fund developers that would sell the housing units to individuals. But however, I think maybe the most critical part of the National Housing Finance being a state-owned entity, I always say when I speak to my colleagues, it's a blessing and a curse at the same time. Because it is a blessing in a sense that being regulated by the state, you are almost guaranteed to be operating under regulations that protect you to exist for long. However, the state is more on impact than, profits. And us having not been capitalized, it calls for us to balance between impact and profit. And also our strategic partners that we work with, they also are looking for profit. So to sort of like balance this thing out, it's in an area where mandate is sort of like restrictive in terms of how and who you can finance, it becomes a bit of a challenge. So we constantly have to maneuver around complex financing structures just to ensure that our transactions that we fund are profitable. So we do provide a number of finance products, but mainly we are a debt financier. In some instances where our transactions are challenged, we do offer junior loan facilities or MES facilities that are purely designed to enhance project feasibility. So we are really experiencing quite a number of challenges and headways in that regard. I mean, South Africa right now is sitting at about a backlog of about 2 million people in the affordable housing space, and the National Housing Finance Corporation on its own would definitely not be able to close that gap. So that's why public-private partnership becomes critical. I mean, we partnered with, some of my colleagues have spoken earlier, the TAF colleagues that are here today. We are solely invested, we are invested in TAF because they operate in a niche market where the National Housing Finance cannot sort of like penetrate, which is in the city centers where you find developers that are looking for, not big checks for them to sort of like construct these opportunities. So they help us to extend our mandate. And a number of partnerships as well that have come to fruition. We also partner with DFIs that we co-finance some of these transactions so that we blend the financing so that it becomes much more affordable for the developer. And importantly so as well, the National Housing Finance does not fund individuals, so we fund developers. But our developers operate in a very strict environment of regulations. We have also found that it becomes difficult for developers to obtain approvals, and it makes our approval process very, very long. So yeah, but we are happy that our partnerships, strategic partnerships, about 10% of our loan book comes through strategic partnership, and it is working, and we intend to increase that over the next coming years.
Thank you, George. Now, can we just turn a little bit into now funding? I know George has described how the state entity participates in a PPP arrangement with private entities like TAF, which is great. Bwana Kehinde, Bwana in Swahili is the equivalent of Oga in Nigeria. NMRC, I think in the recent past, has been contemplating raising external resources. Now, how do you anticipate to manage the Forex risk when you are raising external resources, non-Naira denominated funding?
Thank you very much. And I wish I had an answer to that. I will not be here. That's $1 million question. The best form of hedging is when you do natural hedging. Your revenue is in the same currency as your expense. So dollar for dollar, Naira for Naira. But sometimes you find you run into a situation where it is possibly maybe cheaper to lend from outside because of some economics for you. But then you have to now carry on to yourself some exposure to currency movements. And I think I had a very interesting speaker on Monday when the Shelter Afrique chief business officer talked about they were trying to do a currency hedge, but it quickly mutated into a credit risk. And that's where we all struggle. So there are a few ways in which we have been able to do that. At least one transaction we did at the World Bank. We approached our central bank at that time, and they helped in hedging that transaction because, the central bank has inflows in all currencies, so it's an easier sell for them. But that regime has since changed, and now it's becoming a bigger challenge. How do you do this, because sometimes they don't realize that we have some developmental impact, or that's our main forte. They still see that maybe we are a commercial entity, and so we are profit-oriented. And so when you approach these institutions sometimes, the pricing is done on a commercial term, which makes it a little bit difficult. So some of the ways in which you can do this is maybe you now look for things like diaspora mortgages, so that you also have some form of income or inflows in FX, and that will solve that problem for you in the long run. You could have an escrow offshore where you put some money up front, and then that there it grows with interest and all of that. And more importantly, you can also now look at the transaction itself and have a staggered drawdown approach. I'll give you an instance. When we did a transaction with the World Bank, the first tranche, I believe the exchange rate was maybe 130 naira to $1. When we did the next one, it was maybe 200 and something. The third one was like 400 and something, you know. Imagine if we are taking all the money, but that was fully hedged by the central bank, so there's no problem for us. But imagine if you are taking all the money up front at that lower rate, so you get a lower naira up front for an entire amount, and then naira depreciates exponentially the way it did, then you are carrying a heavy burden. So one of the ways in which I'm putting forward is staggered, so that at least the risk is not on the initial transaction, which will have lost the most amount in terms of the valuation. So I think that's one of the ways to do it. But then you can also now look into other things. As I said, this is a currency transaction. Can there be partnership, or can you have others come in, you know, maybe in different currencies, so that you don't have exposure to just one currency, you know? But unfortunately, over time, because the dollar is a reserve currency, fortunately or unfortunately, it always appreciates against the basket of currencies, you know, so over time. But I think one area that we can look at is, can we have a basket of currencies, so that then you can have that not total dependence on the depreciation of one currency, which is the reserve, and then you're able to better manage that. But it's a very difficult thing to do. And as I said, maybe the best thing is you get someone that you do a natural hedge. You know, your revenue is in the same currency as your expense. Otherwise, maybe you get your regulator, in our case, Central Bank of Nigeria, to help with that aspect of managing that risk, because they have exposure both in local and they have inflow in foreign currency and all of that. So
thank you, Kehinde.
Yeah.
That's very useful. Thank you very much. And I think that's actually a typical example of the issue we were talking earlier about affordability return tension, because even hedging has a cost, implication, and when you factor all that in, then the affordability issue becomes a key concern. Now, Oscar, TMRC started off primarily as a private entity, and now you're having conversations with the government of Tanzania, who are now keen to be a shareholder. Is that a typical strategy for a private-public arrangement, which will be a reverse arrangement of what we have in Kenya, because we started with public. So it was a public and then private. In your case, it's a private-public arrangement, which essentially means the same. What are your views in relation to that?
Thank you, Joe. Actually, let me start by saying, in my opinion, PPP is one of the silver bullets for this sector. There may be some other silver bullets, but this is one that's very important. Now, in the case of TMRC, when you look at the shareholding, you may not see the role of the government, but TMRC is actually one of the examples of PPP on the demand side. Because the way it was set up is that the government actually borrowed from the World Bank and then enabled TMRC to be started. And in fact, the initial seed funding that we've been using, was an IDA loan from the World Bank, 40 years tenure, that we're still using today. So while it's not seen on the shareholding, but it will be soon because we're very advanced in that discussion, the government has been there all along from the beginning. So again, I think from a demand standpoint, for me, these MRCs actually are one of the good examples of PPP that has worked on the demand side. Now, I think where we need to do some work, and Carolyn started to say this, is on the supply side, where we need to bring more PPP on the supply side so that we have more affordable units in big numbers. And I would like to say tough Africa Global, to me, is one of the models that we can use. Because if you can bring the government to say, you bring land, I'll give you 20%, I'll bring the 80, it means the government has skin in the game. So even if from a policy standpoint, if you want to push policy interventions, changes, they are in the business. They will be interested because they have a skin in the game. They have interest in that business. So I think one of the things that we really need to look, and I really like this model, I mean, 20,000 units in Nigeria by a private developer. We can't do that even with public developers in our jurisdiction. So, I mean, I think this is a model that we can replicate in other markets and really have a PPP on the supply side where the government has a vested interest in some of these projects, and it's housing the population, which is very important. So I think this is an area where we still are doing work, and we'll continue to do more work to try to see how we bring in this partnership between government and private sector. I'll touch a bit on the funding, if you allow me, Joe. I think on the funding side, it's similar. So for us, we started with this IDA World Bank loan, but we always had strategy to do more, to have other sources of funding. And a few years into existence, we started to issue corporate bonds, which were locally listed, and we raised a local currency within our market. So you don't have the problem of the foreign currency coming in. The issue of bringing in from outside funding, hedging is the issue. So the only way I know you can deal with that is if you get concessionary funding. Even with hedging cost, it may still be reasonably priced. But otherwise, what we've started to do now is we're looking for DFIs, and I encourage the DFIs in the room to really look at this seriously, to start to lend to us in local currency. And we have recently received funding as TMRC from EADB, East African Development Bank, in local currency. So it can be done. And I think this is a subject that was discussed even earlier this week. I think DFIs need to help us in terms of managing that hedging because they are big, they have the resources to be able to deal with that aspect. Thank you.
Thank you, Oscar. We have run out of time, but in one sentence, what's the most critical action to stimulate private investment in affordable housing, starting from my far right from George? One sentence.
Thank you. I think for me, it's just an enabling regulatory environment. I think that's very important. And when you started, you mentioned that private developers are really reluctant to come through to the affordable housing space. And I think mainly it's because of regulations. So if that can really be streamlined so that, it can enhance that sort of kind of investment, I think that will definitely go a long way in dealing with affordable housing problems.
Thank you. That's a very long sentence. Caroline?
J.O., it's very dangerous to tell a woman to say in one sentence. So I'll try and squeeze it. We have 10,000 words to. So I think there's an opportunity, even as, because there's what we have controlling and what we don't have. I look at Lindsay Finco, which our KCB investment bank helped arrange within a very, very short time. So there's an opportunity for us to innovatively think through what is possible to be done. And that's why I say blended finance has come, the topic is so relevant. So for me, because government is government, and we can ask, all the things that we will ask here will be tied to government. But the question is, as private sector that's sitting here, how can we put our heads together, whether it's use of technology that Empower was talking about, whether it's leveraging on our expertise, what can we be able to do to just be able to bring out instruments that can make housing affordable. It's possible, but I think it will mean more and more of these engagements and maybe even deeper engagements following through. Sorry, that's not one sentence.
Thank you, Caroline. That's a paragraph, but we'll take it.
So quick one for me, I think, is just land access. and then tenure certainty, so that these things, as George said, it runs quickly, you can get your tenure on time, you can get your titles on time and all of that. So if we have that certainty of tenure and then we have access to land and the infrastructure that comes with it, I think that will be a major boost for this bill.
Thank you, Kehinde. Oscar?
I'll do it in one word: funding.
Thank you. That's a very useful sentence.
And I'll use just one word, PPP. We are doing one right now. We do have a lot of investor participation. And I think if it's structured well, that's the way to go.
So I'm just going to give a reaction to the plenary. Does anyone have a comment or a question? And I think we're only going to allow 2 because of time. There's a hand at the back, and is there any other? I think that's the only one. Oh, and there's one over here. And please make it short.
So maybe I'll go first. Moriga from Wood Green, Toronto. So what we've been doing with the PPPs is pretty much what you're saying. The one thing that I find that we have an advantage is when we de-risk this modern construction methods. Because if we can de-risk these new methods that the private sector hasn't yet adopted, it will attract not necessarily the traditional private sector, but newer private sector, because the old private sector is also a little bit too stuck. So my question is around the de-risking new construction methods, modular. Yesterday we visited a site on 3D printing, etc.
De-risking construction. And then your the last person over there? Did you direct that question to any particular panelist? Very well.
Hi, I'm Kennedy. Thank you for that exciting and informative discussion. I think I have 2 questions. One is related to what he's just said. This would go to Caroline. You've mentioned a very critical point that the demand is there, the supply has got an issue, and you mentioned price, labor will remain the same and all that. New technology is a key component into reducing this cost and making sure that the cost of the units are actually affordable. What is the place of affordable alternative technology for construction within the bank's financial model? And this I would also direct to KMRC, Mr. Johnstone. What is the place of this as well with financial institutions like yours? For example, when we are looking at technology and programs that don't necessarily lie under the bank financing or the SACCO financing, are you open to engaging at that level? Thank you.
Gentlemen and lady, who could take the first question?
Okay, I will touch briefly, and the panelists can add. So, de-risking new construction models, yes, I agree, because when you look at the cost of construction, one of the things that drives the cost is the time it takes to deliver a unit. So if you're able to reduce that to, from 45 days or 90 days to a unit that can be produced within 2 days and in scale, there is an opportunity in there. I think we are sitting in a very good space as a country because we just have a new building code. That was initially it was a bit restrictive, but we have a new building code which a lot of the banks have adopted. And so there's an opportunity in there for you to be able to already reduce the cost even before we start speaking about de-risking. De-risking becomes still key, and that's why even in our model, we are looking to work with partners who can still offer some form of guarantee in there. And that way we see how we can make the cost lower. Because if I'm able to have a call on my credit risk, then I'm able to make a call on the premium I'm charging. So yes, they're there, they're already working. On the bit on the ABTs, I think we are very keen. You might be aware that KCB is one of the accredited agencies for Kenya Green, GCF, Green Climate Fund. And one of the things we are looking for the developers that we are working with is to, one, ensure that they are IFC certified, but in there is a conversation on how we can be able to raise a sustainability-linked bond. And this will sort of like, bring the cost down and looking at all aspects, whether it is gender inclusivity, whether it is low income, targeting incomes, the informal sector. So I'll say it's work in progress, but there's an opportunity there. We're already in discussion with the GCF. We are working with the ministry and the BCRAP, Building Climate Resilient for the urban poor. There's an opportunity to even bring in more bigger money, and given that Kenya and Brazil are leading that conversation, and KCB is on the table to see how we can help to support the region.
Thank you, Caroline. I think I want to summarize, and I'm just going to add into that. When you're looking at de-risking arrangements, particularly for supply, it does not necessarily mean that you have to do a guarantee. If you have an arrangement, for example, of an off-take, it's a form of de-risking. Because you see when you have construction finance or developer finance, what happens? You need to pay the money back, of course, after construction. So to take care of that risk, and you get an off-take guarantee or an off-take arrangement, that actually is a form of de-risking. I don't know to what extent we currently have that kind of arrangement. Finally, in relation to whether KMRC is willing to have a discussion on innovative building technologies, yes, we are willing to have the conversation. But when you come for the conversation, we have no experience at KMRC dealing with supply, dealing with construction. We deal mainly with demand and user finance. So, but you'll educate us a little more about what are those technologies and how we can support you in one way or another. Ladies and gentlemen, we want to mark the end of our panel. Please appreciate our panel. Thank you.